Most people are looking at this market right now and assuming it is just another fake move, another temporary pop that will fade, another head fake designed to lure people in before price rolls over again. That belief feels reasonable because it is based on memory, on what has happened before, on past failures. And that is exactly why it is dangerous. Because markets do not repeat based on memory. They repeat based on structure. And structure is not the same anymore. What most people miss is that real breakouts do not begin with excitement. They begin with boredom. They form when price goes nowhere, for long enough that confidence quietly shifts in the wrong direction. When rallies fail just often, enough to convince participants that strength should be sold and weakness should be trusted. That is how the crowd gets positioned on the wrong side without realizing it. And that is exactly what happened here. For weeks, price moved sideways. Every push higher was rejected. Every dip felt like the beginning of something bigger, but never followed through. This kind of action slowly conditions behavior. Traders stop buying strength. Investors stop paying attention. Shorts grow more confident. Weak longs give up. And while nothing dramatic appears to be happening on the surface, something very important is happening underneath. Positioning is building aggressively in one direction. This is where most analysis fails. People focus on candles, indicators, and headlines, but markets do not move because of opinions. They move because of imbalance. They move when too many participants are leaning the same way and the market reaches a point where it can no longer accommodate that positioning. When that happens, the path of least resistance flips. One of the clearest signs that this flip was approaching was the repeated failure of downside follow-through. Every time price dipped, sellers failed to press the move. Volume dried up, price stabilized quickly. This is not strength from buyers. This is exhaustion from sellers. And exhaustion matters because once sellers are spent, there is nothing left to absorb buying pressure when it finally arrives. And when buying pressure arrives, in a market with thin liquidity and crowded positioning, price does not drift higher politely. It snaps, it accelerates, it forces decisions. That is why this move feels sudden to so many people. Not because it came out of nowhere, but because they were not watching the right things. Short sellers are now trapped, not as a dramatic phrase, but as a mechanical reality. A short position has only one exit. It must be bought back. And when price breaks above a level that invalidates the short thesis, the trader is forced to choose between taking a loss now or risking a much larger one later. When many participants are forced to make that decision at the same time, their buying becomes fuel. It pushes price higher, triggers more stops, and creates a feedback loop that accelerates the move. This is why breakouts from compression are often more powerful than breakouts from extended trends. During trends, positioning is already aligned. During compression, positioning becomes skewed. Expectations become misaligned, and misalignment is where asymmetry is created. Risk becomes higher for one side than the other. Another critical element here is sentiment. This breakout did not happen when optimism was high. It happened while skepticism was still dominant, while most people were still waiting for failure. And that is exactly when breakouts have the most room to run, because disbelief is fuel. Every rally that does not immediately fail forces skeptics to reassess. And reassessment often turns into buying. It is also important to understand that this market is not moving in isolation. Broader liquidity conditions are shifting. Volatility across markets is rising. Real assets are being repriced. In that kind of environment, shorting a relatively small and thin market becomes far more dangerous. It does not take massive capital flows to move price. It takes imbalance. And imbalance is exactly what you get when downside bets outweigh available liquidity. As price pushed higher, key technical levels that had capped the market for weeks were broken and flipped into support. This is not a minor detail. When resistance turns into support, the internal logic of the market changes. Former sellers become buyers. Traders who missed the move wait for pullbacks that never quite come. Momentum builds not because of hype, but because positions have to be adjusted, whether participants like it or not. This is also where the psychology of the trap really reveals itself. Many shorts initially refuse to cover. They convince themselves the move will fade, that it has done this before. That patience will be rewarded, but time becomes the enemy in these situations. As price holds above the breakout level, margin pressure builds. The cost of being wrong increases, and the opportunity to exit cleanly disappears. By the time capitulation happens, price is much higher than anyone expected. What separates this breakout from past failures is not just price, it is demand. Because this market is not purely speculative. There is underlying Real-world demand that does not disappear just because price moves higher. Industrial users still need supply. Contracts still need to be filled. That creates a natural flaw under the market that did not exist in moves driven purely by speculation. At the same time, investors who had avoided this market because of repeated disappointments are being forced to reconsider. Once a market demonstrates that it can break and hold above key levels, the narrative shifts. It moves from selling rallies to buying dips. And that narrative shift is powerful because it changes behavior. What used to be selling pressure on pullbacks becomes buying interest. This is why early breakout phases often feel uncomfortable. Price does not move in a straight line. It surges, pauses, consolidates, and then surges again. It shakes out late shorts and impatient longs at the same time. People waiting for perfect entries find themselves watching price move away, which creates frustration. And frustration often leads to emotional decisions at the worst possible moments. Volatility also plays a critical role here. Breakouts increase volatility, and volatility forces position adjustments across the market. Risk models change, funds rebalance, correlations shift. A different class of participant becomes involved. Traders who thrive on movement rather than stability, their participation adds another layer of demand that did not exist during consolidation. This is also why volume often expands after the breakout rather than before it. Confirmation brings participation. Participation brings follow-through. Many people wait for confirmation thinking it reduces risk, but confirmation actually shifts risk from direction to timing. By the time the move is obvious, the easy part is already gone. None of this means price will move higher in a straight line. Sharp pullbacks can and will happen. Volatility cuts both ways. But what matters is not the size of the pullbacks. It is their character. Strong markets absorb selling quickly. Weak markets do not. That difference tells you far more than any prediction ever could. One of the biggest mistakes people make during breakouts like this is overthinking them. Looking for reasons not to believe, waiting for a pullback that never quite arrives, or exiting too early because the move feels uncomfortable. Discomfort is not a warning sign. It is often a feature of real transitions. Markets do not reward comfort. They reward correct positioning. The most important shift here is not a price target. It is a mindset shift. The burden of proof has moved. Instead of asking why price should go higher, the market is now asking what will stop it. And that alone represents a major change from the environment this market has been stuck in for years. From here, the path forward will be decided by behavior, not opinions, by how price reacts to pullbacks, by how quickly dips are bought, by how the market responds to negative news, or ignores it entirely. Real breakouts are revealed through behavior, not headlines. Whether this move extends modestly or aggressively is still unknown. But the message from the market is already clear. The downside is no longer the easy trade. Old assumptions are being challenged, old strategies are being punished, and a new phase is beginning. When a breakout is real, price does the talking. And right now, price is speaking very clearly.